What's up YouTube? This is Todd Horse here with Tasty Tracker. Today I'm doing the second video in this series, the long-term holds video. And in this video I will go over my 23 picks of the stocks that I'm building a portfolio around. These are I'm taking the money that I'm making from my options and I'm dumping in here to hold them to not keep me from being tempted to take that and blow that all on more options positions that are ultimately risky and could blow up my account. Normally I do a VIX hedge, and I will resume doing that in a bit once right now VIX is around 20. Once it gets back down to around 15, I will be jumping back onto the VIX hedge. But for now, I'll hold off on doing that. So this video is what I'm doing right now in order to have my account still grow a little bit from the increase in value, grow a little bit from dividends, and more importantly, keep me from doing something stupid. So what I'll cover is the difference between ETF index mutual funds, basic stuff here. Is our dividends our goal? I already hinted at that a little bit before, and I'll talk about that. Which fund managers are the biggest and best, and what are the risks associated with these types of funds, and my 23 picks, 3 of those are stocks, and then I'll go have a little conclusion. So getting started, ETFs are simply a basket of stocks that are lower fees than what a traditional mutual fund was. So mutual funds have been around forever, and those were also a basket of stocks, but because they were managed by a fund manager, they cost more to maintain those, and they really went out of favor when people were realizing not only were they getting charged a lot, but it wasn't actually outperforming the market anyway. So that's where indexes and ETFs sort of came in. Indexes are basically the same thing as ETFs. There are some minor differences. Some of that is dealing with dividend payout and reinvestment, that kind of stuff. But for our purposes today, they're basically the same thing. Again, another basket of funds. The last thing here is now they have managed ETFs, which you would say, well, isn't that just a mutual fund? In a sense, it is. They have higher fees than what your traditional ETFs have, not quite as high fees as mutual funds have, and there are some minute differences, sort of like indexes and ETFs, where there are, for the average investor, you're not going to notice any differences, but there are differences between a managed ETF and a mutual fund. So moving forward, I want something that grows over time. I talked about this in the previous video. I don't want to lose out to inflation. My goal is not to live off of dividends. If you do the math on it, it just does not make sense at all. And frankly, holding stock doesn't make sense at all in most cases. So my main goal here is to protect myself from myself and to put positions into stocks so that I don't have access to the cash. It's not quite as liquid, and that's a good thing for me personally because it sort of hints off. I can say, oh, that money's in that position, and I'll just let it ride. So back to dividends, they're just a bonus. Anytime you can get a little bit more dividend, sure, why not get it if that fund is still increasing in value? But if it's staying flat, or worse, going down in value, why would you hold on to something just because it pays out a dividend? And so if you look at the average US salary, it's about $50,000 a year. And for these cases, these are about 1% dividend payout. You can maybe get 4 or 5%, but there's not a whole lot of stock to choose from that are in that range. And do you want to put all of your money into 2 or 3 stocks that pay that high of a dividend? Chances are you want to diversify, and that's going to bring your payout percentage down. So anyway, if you times it or divide it, $50,000 divided by 0.0131, that's 1.31%. That's going to be about $4 million you would need to make a $50,000 a year replace that salary. So let me say that in a bit more logical way. If you want to make $50,000 a year off of dividends, you would need to have $4,000 invested in some of these ETFs. If you had a higher dividend funds, you might be able to get away with 1.5 to 2 million invested. But really, if you have $2 million, you could invest that in so many other better ways than just trying to live off the dividends. You could buy real estate and have rentals, which is what I would do if I had $2 million sitting in cash. Having that many rentals would net you way more than $50,000. So dividend investing to me is basically a joke. But don't just take my word for it. Do the math and think about it for a minute, and you'll realize it is just a nice bonus. I'm not saying it's not nice. It's definitely something nice. It's in a sense free money, but I would rather choose a stock that's going to increase over time. So most of the funds that we picked here today are from BlackRock, iShares, Vanguard, Spider, Fidelity, and ARK, and those are basically in order of popularity. BlackRock has the largest funds. Vanguard has been around forever, and so they have a million ETFs and lots of customers. Spider, again, those are basically your top three that you're going to be dealing with 99% of the time. I threw in some Fidelity and ARK, and we'll go over those in a bit. Okay, so I already talked about managed funds a little bit, but ARK is they have a series of managed funds that they do a lot of research on. So you're going to pay higher fees for those, but the result should be that you get better returns. And actually, these have worse dividends too. So that's also part of the reason why I'm choosing, 33 of these and not just one. You shouldn't be dumping all your money into one. But some of the risk I thought about, what happens if ARK goes away? You can go to this link, but the research I've done has said that they basically will hire a new new account manager, and your money will be fine, and somebody would take over that. So it's not to say that you would want to continue holding it. Maybe the new managers aren't good. Maybe it ends up being a better thing, because bullet point 2 is, although you can't lose your money from the company going bankrupt, they can make terrible decisions. So you have to be concerned with the company managing your ETF, if it's a managed ETF, in case they make terrible decisions and lose all that money. The last thing here is that managed ETFs cost more than just, say, an S&P ETF, which doesn't need to be managed at all because everybody knows what's in the S&P. So here is the 23, and I'll go ahead and click on that doc. I will put this link in the notes, and I have it shared to everybody, so you can reference this whenever you want. But I ordered these by price. So first here I have the iShares Innovative Healthcare. Then we have Quality Factor, High Dividend, Large Cap, ARK Innovation, which is their largest fund, ARK-K, Vanguard Value, 2 biotech ones, so you could choose either or. I personally like XBI better, so that's the one I will be sticking with. But one way you can choose to what matters the most to you. Does dividend yield matter the most to you, or does expense ratio? And for me, XBI is a little bit lower expense ratio, and I'm not too concerned about the dividend yield, as I talked about before. So yeah, I would only choose one of these, but if you want to, you could dive deeper into what holdings they have, and it might be varied enough that you would be interested in both. One's provided by Spider and the other one by iShares, BlackRock. Then we have bonds. Then we have a total stock, another healthcare, S&P 500, growth, which is different than just the general S&P 500. So Vanguard takes the S&P 500 and then looks for a subset of the best growth stocks within that. And so then these two, VOO and SPY at the end, VOO, these are just general S&P 500s by different providers. So again, you would only be getting one of these. And there again, I would lean towards Vanguard because of the lower expense ratio, and then it has more in assets. My 3 stocks that I'm bullish on are MasterCard, Apple, and Amazon. The most bullish of these three for me personally would be Amazon, but any one of these three, as I talked about in the previous video, I can find a number of reasons why they will fail. And so holding in any individual company to me is scary. I would rather hold an S&P 500 because although I'm definitely going to make less than a growth fund, remember my goal for these is not to make money. My making money comes from options or the occasional stock play, but for the most part options. My point here is to keep my money safe and growing, but at a slower rate and have it be less accessible to me. Okay, and then the last set here I do have ARK K up here, and I have the rest of ARK's funds down here. And again, these are all managed funds, so they're all going to be higher expense ratio than anything up here. And they're smaller funds, so yeah, not they're still pretty big. I mean, 36 million is still a lot, but if you compare that to up here, this iShares is probably the lowest, but anything above that, this is million, and then these are all billion. So ARK still has a couple relatively small funds here. So yeah, so you can see I have the price listed. I have the dividend yield amounts. P&E, if you're interested in that. Optionable is very important. So I only bolded the false ones here. If that should not be bold. If you want to do a covered call or something like that, you need to have options. And so the cheapest one that you can do that here is the VYM for $80. Obviously, if you bought 100 of those for $8,000, then you could start writing covered calls. I'm not opposed to doing covered calls, certainly, but in these, that would not be my main goal. My main goal is just to hold something other than options. So yeah, depending on what you value, this is the high dividend yield. So that's getting 3.5% on the dividend, which is nice. It does have options, 0.06, which is one of the lowest. 0.03 is the lowest. These two both have 0.03. You'll notice most of these are Vanguard, and again, that's because Vanguard has been around the longest doing these. Down here at the bottom, I have some links to which I wish I would have found this site prior to doing the spreadsheet, because I pulled from a bunch of different sources. So yeah, if you don't mind, give me a thumbs up. I did spend quite a bit of time building the spreadsheet, even though it doesn't look like much, because I was pulling it from multiple sources. Turns out I could have just gone to this site, which is pretty great. But if we click on that, they have a whole bunch of different groupings, so you can go in by category. I have no affiliation with the website either. I guess I should say that. But I just linked to the different, what they call channels. And so you can click here and see all of Schwab's ETFs, which is pretty nice. So they have 2 pages here. But if I go back and click on channels here, loading. So yeah, you can go, mid caps here. You can go by sector, coal, whatever, REITs, commodities, regions. So yeah, it's not loaded yet, but this is a long page of all the different ETF lists that you can get. So yeah, do come down in here if you want to look for a specific company. I opened up a Schwab account just to many years ago, because I thought that was the only way I could get some Schwab ETFs. So I still have that account running, but that's just because I've been too lazy to move that over to another account. So anyway, let's go over these accounts or these tickers. I'm starting with the top here. $30 is great to me. That only requires $3,000 if you want to start with. If you wanted to get 100 shares, of course, it doesn't necessarily matter here because you can't do options anyway. But if we go ahead and look at the max chart, we can see it's clearly trending up over time. So it's not moving anywhere fast. Back here in 2018, early 2018, it was around $22, and it's 30 now. But that is still an increase in value, especially if you were able to buy the dip here on Corona. But this is the type of chart where I'm looking for to have an increase. And of course, you can get a lot of your data here. I linked to Yahoo because they have most data points people are looking for. Moving on to Fidelity, 5-year. Again, looking at the 5-year chart to sort of get a feeling of where it's moving. And back here in 16, it was 25. Again, not a huge dramatic increase, but I'm looking for enough to keep up with inflation. VIM. So I don't know that I want to go through each one of these just to bore you with, but again, I'll put the link in the description, and then you can. Now this one actually is, since it's so focused on dividend, it is growing a little bit, but it's paying out any gains that it's making, really. So again, I guess I put that on there because it's staying flat or better, and it is giving you some dividend exposure. So yeah, go through here. Some of the names like TLT, XBI, and SPY, these are all extremely heavily traded normally, so you're probably already familiar with those. But this is my list. I basically am starting at the bottom here and doing $1,000 in each one, and then I'll circle back, do another $1,000, and so on and so forth. I will go to ARK-K just because I'm a fan of ARK and their methodology, and we'll look at their chart. Now these again are all newer. I had it on, yeah, so ARK only started in 2014. So you can see Fidelity's 1946, 95, 75, 88, and ARK, definitely the black sheep here of the family. But when we go look at their results, obviously that doesn't necessarily mean it will continue this, but basically all of ARK's charts look like this, where they're very good growth. So we can see down here in 15, that was $18, and now it's sitting at 84. So that is even before COVID, that was at 51. So you know, over doubled in those years. So you definitely want to mix some of these up, but I wouldn't just do these because the unmanaged ones are, I guess, more stable, less susceptible to user error. Okay, so those are the 23 picks. Again, I'll put the link in the description. You can go through and see which one fits for you. But ultimately, you need to do what you like the best. For me, the idea of dividends is nice, but typically people that are building dividend-based portfolios are chasing dying companies that have these fat dividends because they're no longer investing in innovation and instead paying that off to their shareholders, which is great. However, you don't want to lose more money in the stock decreasing in value than what you're pulling out in dividends. That makes no sense. Companies come and go, they get new CEOs, new competition pops up suddenly, randomly, and can outcompete, especially with technology. And so I don't feel comfortable dumping huge amounts of money, especially if we're talking about something like Amazon, which is $3,000, you know, so you need $300,000 to get 100 shares. That would be terrible to dump all of that into one stock, in my opinion. And so in order to go against that, I'm, you know, for the purposes of what I'm talking about here, for insurance against myself, I'm only interested in ETFs. And I'm really using this as insurance against myself and black swans, and maybe minor dips. But my account should be able to handle minor dips where maybe I lose on a position or two. But for the most part, I'm protected because I have varied expirations. I have varied tickers. I bought dips, and I'm moving with the market. I'm using the trend to guide where my positions are going. So I'm going to do bearish in a bearish market and bullish in a bullish market. So all of that should help me prevent losing the vast majority of my account in any individual normal situations. But when we get black swans, these stocks are able to be sold. And I want to dive into a second here, the diversity of the ETFs. So I have these 23 ETFs that I came up with, and I could have just chosen SPY, but perhaps SPY does bad one year and XBI does good that same year. Those may offset each other, and so that's the reason I'm diversifying. I'm not necessarily diversifying to protect against a black swan. So when you get into these extreme environments, like with COVID, everything's going down. It doesn't matter if you're in things that you thought were diverse from another. You could choose different sectors, but every sector's going down. So that's not really what I'm trying to do by diversifying. I'm trying to even out when the market is in normal conditions. So if a black swan were to happen and I want to sell out of these positions, I would be most likely selling out for a loss, but so maybe my cost base is 100 and I'm selling them for 80 or something like that. But the point is that I'm raising cash to then put back into options, which are how I make my money in the market, and I don't have to pull any money from my personal account. I can, like my savings account or something like that, I can keep trading with the money that's already in the account that's just sort of been sitting on the sidelines. Okay, so yeah, I think that's it. Hopefully these two were at least a little bit clear. The main part of the video there is checking out my spreadsheet, and go feel free to do that and post any questions if you have any. Do you like these tickers that I picked out? Do you not like them? Should I add some? Should I be aware of something that I'm not? What are your thoughts there? And leave them in the comments below. I will update the spreadsheet and we can have a discussion on that. Yeah, so I'm really interested in your feedback on the picks that I have. My website's tastytractor.com, and it's free for you to track your stock and options trades. So here again is the list, and certainly you can pause the screen there and take a screenshot, or you can just visit the link and mess around with it there. Thanks, guys.